the most expensive NBFC after Bajaj Finance, of course, but pretty close to it. It's closed the gap quite a bit. So that's the management chat coming up at 9:40. But for now, let's keep it with the markets. Nilesh Shah is Managing Director and Chief Executive Officer at Envision Capital. He's joining us right now, right here in our studios. Nilesh, thanks for dropping by. Great to have you with us here.
Thank you. Thank you, Prashant.
How are you feeling, Nilesh, about the market? And last time I think we spoke, you talked to us about one area which you're very bullish on, which is home improvement. And you continue to remain bullish on that space. We got lots of numbers recently from that space. I don't know if you count, say, things like Polycab, etc., as part of it. You own it. Just wanted your thoughts on that space now.
Yeah, absolutely, Prashant. I think real estate is probably one of those few spaces which is really coming out of a very, very long slumber. We think the entire residential property market currently is booming. Home improvement is booming. I think demand for mortgage loans, I think, is again very, very strong. And the kind of numbers that we've seen so far, the quarterly earnings, I think has been fantastic. I think just about a fortnight back, JLL came out with a report which said that, sales of homes are up 21% year to date from Jan to June. And probably home sales are at a 15-year high. And that's translating to strong demand. Along with that, of course, there's some moderation in terms of raw material costs, input costs for many of them. But otherwise, I think strong demand, strong revenues, strong margins, strong earnings. I think it's a great space to be in.
Specifically, what, if you want to name names, that'll be fantastic. What do you like?
Yeah, so I think we own a combination of names there. On the home improvement side, we've been owning Polycab now for maybe 3 years or so. And that's been a great ride so far. They continue to be delivering, gaining market share, growing volumes, managing margins really well, getting into adjacencies. I think that's been a great story so far. One of our most recent additions was Stylum about 4 or 5 months back. That makes laminates. Largely focused on exports market, but now trying to kind of make some headway in the domestic market. We own both of these names. On the mortgage finance side, we've been owning it through Home First. That's been like kind of an incredible growth story so far, growing at 30%. And managing spreads and yields and NIMs really well, and managing the asset quality as well. So I think that's been a great place. And another position we've been owning for a very long time now is Kolte Patil, focused on Pune, Bangalore. These have been the big hubs in terms of demand for mid-income housing. So it's been a combination, the way we've really been positioning ourselves and participating in this great story. And we just think that it's still kind of early days. The journey has just begun.
Okay. Nilesh, hi. Morning. You're joining us on a very interesting morning when there's a sea of red across Asia. All markets are down 2%. Relatively, actually, we're much better off. I mean, India is down only 0.5%, considering the kind of cues that we had. What's the thought on the overall setup now? 19 times, you've seen bulk of the earnings. There's been massive liquidity so far, at least. But I'll tell you why I'm asking this question, because there's some murmur, some thought about the China re-entry trade again, because there's stimulus over there. Now you have these dislocations, the BOJ perhaps trying to loosen its control on the yield curve. You have a downgrade on the US coming in. Slightly big events which perhaps weren't baked in. What's your thought as we look at the rest of the year?
Well, given the kind of advances that we've seen in the market over the last maybe a quarter or two, and the kind of re-rating that we've seen, partly, of course, it got backed up by strong earnings growth as well, especially in the mid and the small cap space. But otherwise, overall, with the kind of advances that we've had so far, maybe in the short term, the ride could get a little bumpy. I don't think we are now anymore immune to any of the adverse macro developments, especially on the global side. I think it was a very different situation in Q1 of this calendar year when markets were still kind of low, subdued, participation was limited. And I think at that point of time, at the lows, markets are always more immune to negative developments. But I think the kind of advances that we have seen, I don't think in the very short term there's any room for disappointments. Either disappointments on the very macro front or disappointment as far as companies' performances go. And you will see some kind of, knee-jerk reactions to any of these developments. But I don't think this in any way alters our medium to long-term growth trajectory. I think that pretty much remains intact. We saw the GST data yesterday.
Yes.
Again, very strong performance.
Crores, yeah.
I think any administration, any government across the globe would pretty much saying, wow, 11% growth in a month like July. And keep in mind that that's not like a busy season for us.
Yeah.
July is like kind of, and we've had challenges of excess monsoons, excess rainfalls. So keeping all that in mind, I think yes, in the short term, it could be a little bumpy, but I think we should be fine over a more medium to long term perspective.
Hey Nilesh, good to have you in the studio, Nilesh.
Hi, Nigel.
I wanted to ask you about this. You spoke about the real estate space, but not just real estate, but a couple of sectors and segments. Since there's a lot of liquidity, a lot of interest in various companies, a lot of promoters are taking money off the table. That's very debatable whether or not they're getting an easy exit. Is the buyer the smarter one? I wanted your comment on that. Yesterday we had DLF sold just to 1% odd. But more of the same. I don't have the data, but I think in the last quarter or so, we've seen quite a few promoters take money off the table. What's your view on that?
Yeah, so Nigel, this is the adage that, promoters are the biggest insiders. So you can't beat them at that game.
Yeah.
And obviously,
that's the problem, but I'm worried about that.
So Nigel, yes, in the short term, it does create a bit of an overhang, and it kind of gets you a little apprehensive in terms of what's triggering this. A lot of these promoters, Nigel, are first-generation entrepreneurs. They haven't seen this kind of wealth built up. I think for them, apart from growth of the business, the security of the family or feeling a little bit more stable, I think is as important. Maybe in some cases it is driven by that. I'm not sure if it's entirely driven by that. In some cases it could just be the meteoric valuations, the kind of up moves that they have seen. They've never seen this before in their life.
Yes.
So I probably think it's driven a lot by that. And my view is that yes, in the short term it does create an overhang. But I think for well-run businesses over the long term, I think it's pretty much okay. And probably the buyer will get a better deal in the long run.
Okay.
Nilesh, you like another specific company, MapMyIndia, which has done well over the last couple of quarters. Just tell us about that story and why you like it.
So I think, Prashant, it's a very interesting kind of a business. I think it's probably one of those very unique deep tech companies out there. Majority of our tech companies are either IT services companies or they're product or SaaS companies. But this is essentially a deep tech company which is focused on mapping solutions, navigation solutions, geospatial solutions, where the use case is very broad-based. It can pretty much play a role in pretty much any sector of the economy that you can think of, be it mobility, automobiles, aerospace, space, defense, urban infrastructure, various development projects. I think it's a very broad-based kind of thing. So I think from a very long-term perspective, obviously it's not going to be for the faint-hearted who are looking at quarter-on-quarter performance, given that they have elevated margins, and growth can be bumpy along the way. So maybe if you're looking for 1, 2, 3, 4 quarter perspective, it may not be the best idea. But I clearly think thematically and directionally, from a very long-term perspective, like say a 5-year plus horizon, I think it's a very, very interesting business to ride.
Since we're talking individual interesting businesses, I want to get your thoughts on some of the newer listings because they're actually coming in from very interesting spaces. There's IdeaForge, a drone company. There was NetWeb that's into heavy-duty supercomputing, I think, and these listings have been quite phenomenal. Anything that is of that maybe you didn't buy, but you found interesting because the valuations are also a question. The market's really running after anything that's a new idea.
So, Surabhi, that's an interesting thought. I haven't looked at any of these names in any greater detail. I think from a pure thematic perspective, they all look extremely interesting. But here's my take on some of these fresh listings that I think it's best to wait for, a few quarters. We've seen in some of these cases, some of these numbers, margins, they get elevated just before the IPO. And post the IPO, after 1 or 2 quarters, 3 quarters, the managements do present some really great credible reasons as to why margins have tapered off, why growth has tapered off. And that's the time when, if the valuations remain elevated, then the market does essentially kind of give a root shock to the stock price. So I think it's better to kind of really wait for some more execution.
And then
yes, in the process, you may lose out on 1 or 2 opportunities. But I think on the whole, if you kind of take a step back, look at it, see how the medium-term trajectory is, how's the execution, and then take that leap of faith.
Okay, let me ask you about the other side. So that's all new technology. Let me ask about classic old technology, right? We've had this discussion for so long. And it's been astounding. There's JP Morgan, for instance, they're like the perma bear on technology. And their argument is that this is not about 1 quarter, 2 quarter disappointments here and there in BFSI. I'm just taking their argument.
Yes.
Saying that this is basically a reset to the pre-COVID normal. That's what large companies are going through right now. I don't know. Do you agree with that, if at all? How would you look at what's happening in traditional tech?
No, I think that's a perfect hypothesis. I mean, I don't disagree with that at all. I mean, the reality is that our large IT services companies are pretty much doing the routine, mundane things in terms of deploying technology, deploying solutions for the enterprise customers. And that's a segment which will keep growing probably in mid to high single digits in dollar terms. Okay. And so that's where it is. They continue to basically be able to grow profits at a slightly higher pace with better execution, better efficiencies, better productivity, and of course taking a dose of automation as well out there. That's where, and on top of that, if you have the currency depreciating, that's the big arbitrage that they have within themselves. So these are the three factors. But the bottom line is that I think margins have peaked given the kind of COVID situation was there. I'm not too sure if the currency has too much of room to depreciate from here. So you are now back to essentially volume-led or revenue-led growth, which is going to be mid-single digit. That's been the story. I mean, even if you look at any of the large IT services companies over the last 10 years, I think the growth rate, even in rupee terms on the revenues, has probably been just 10, 12%. It's nothing, I mean, over a very long period of time. So I think that's going to be the situation. So you're better off buying these kind of stocks at maybe the lower end of the historical range in which they have traded in terms of P multiples. That would be a good time. Get in there, do your arbitrage, and wait for a great time again where sentiment turns back. There's a new theme. Maybe AI is going to be the big theme a year, 2 years later. That's probably the time when you could probably look at exiting. But having said that, there will still be opportunities in mid-cap IT, tier 2 IT, where there are individual companies addressing niches, where they're able to grow in strong double digit. So maybe that's probably the segment to really watch out for.
By the way, Surabhi, Perma Bear is a pretty serious acquisition too.
Well, I mean, they present a thesis with a lot of conviction.
Just
Maybe
kidding.
not Perma, but at least for the time, not Perma, a present Bear. Let's just say that.
Pulling your leg.
All right, Nilesh, thanks so much for coming down to the
Pleasure.
studio. Good to have a chat with you as always. Looking forward.
Thank you, Nigel. Thank you.
Chatting up with you, rather.
Thank you.
Thanks, Prashant.
Well, time to move on then. And let's focus on a company that delivered a very strong set of numbers, Pikaji Foods. In quarter one, they looked quite good. Revenues, profitability, both of them surged.